Good afternoon, everybody. Welcome to today's Powerplay Tuesday with Quest Trust Company. Today we've got a great presentation for you. We have Christian Catrone on speaking about cash is trash, but cash flow is king. Christian is a co-founder of Redeem Capital, who they're an investment sponsor for real estate investors. So we've got him on today to kind of talk a little bit about some different passive ways that you can invest your money. So Christian actually began his real estate investment career in single family homes in 2017. Like I mentioned, he's a co-founder of Redeem Capital. And kind of his vision for the company was specifically expanding in commercial real estate investments, focusing on renewable energy investing. So his company, like I said, they run an investment fund that does provide financing to renewable energy developers, and they have investors that invest through them. And basically, I'm sure he'll talk a little bit more about this towards the end of his presentation. But providing investment growth and yield to their investors. So his corporate career also includes roles in sales, training, management, business development, project management, and operations, leading as many as 500 teammates at a time. So that's a little bit about background on Christian as well as his company. So we'll bring him up here shortly. A couple things I do want to explain before we get started. Any questions that you will have, please feel free to put down in the chat. We'll have some time for Q&A at the end. We're going to let Christian do his thing here shortly, go through his presentation. I've got some announcements on the Quest side as well after we complete that. And then we will have some Q&A, hopefully 10 to 15 minutes or so at the very end. So stick around for that. Please put your questions in. We'll kind of get them to Christian there at that point. Really quick, before we do continue, this is the last thing I have to say, I promise. Just a very quick disclaimer before we get things started. So Quest Trust Company cannot provide any sort of tax, legal, investment, or deal structuring advice. So please bear that in mind as we bring Christian up, as we go through the presentation, and everything that's said on here today truly is for educational purposes. We're not here to endorse any kind of investment or product or service, right? So this is to kind of help you as whether very experienced investors or people more new to the self-directed space to kind of expand your knowledge, get a little bit of education on some different investment types that you can utilize for yourself. So with that being said, I'm going to pull this down and let's go ahead and bring Christian up. Christian, thanks so much for joining us today. We're incredibly excited to have you on and looking forward to your presentation as well. So let us...
Fantastic. Thank you guys so much for having me. Can you hear me okay?
Yeah, absolutely. Yep. We hear you loud and clear.
Okay.
So
okay,
let
fantastic.
me go ahead and bring your presentation.
Yeah, thank you again for having me. I really, really appreciate the opportunity.
Absolutely. Yeah, I'll let you take it away.
Okay, fantastic. Yeah, I'm a big fan of Quest Trust Company. I have been working with Quest in numerous different facets for a long period of time now, ever since I got into initially residential real estate, and since have converted and pivoted to doing commercial real estate. And in that, have had the opportunity to work with Quest from a standpoint of allowing investors to participate with us in the deals that we're doing. And so very familiar with Quest and all the wonderful things that it does. And so really, really grateful again to be on today. The thing that I wanted to start off by saying is that this photo of me is a little bit outdated. I'll actually a lot more gray hairs now, if you can see in the video. And so if you can see, I've matured and aged a little bit, but that's a young whippersnapper there that I'm looking at. The second thing that I'll say is that, admittedly, this title is somewhat provocative, and at least, if nothing else, should cause some curiosity as to what is this guy going to say about. And we learned that cash is king. And the argument being made today is that cash is trash, but rather cash flow is king. And so thank you for giving me the privilege of being able to share some thoughts here as we go on. Let me start by first saying my name is Christian Catron. I'm the president and CEO of a company called Redeem Investments. We're based in Austin, Texas. Our tagline here, renovating properties, transforming lives. We believe wholeheartedly in exactly that. Hopefully I have a chance to share a little bit about that here as we go on. Similar to what was just said, I mean, there's sort of a disclaimer here. I do make mention, while this is not sort of a pitch by any means for our investment funds that we have available, I do want to make certain that folks know that that this is for educational purposes only. While I do make mention of our investment thesis and some things that we're doing within our funds, this is by and large purely educational and for informational purposes only. A little bit more about Redeem Investments. We are a faith-driven company, not ashamed to say that by any means, that we focus entirely on ESG, commercial real estate, and renewable energy. Let me explain a little bit about that because, unfortunately, that word has sort of become politically charged in a way here. Whatever it is that society wants to call companies that focus on not just generating profits, but also taking care of people, and in so doing, not destroy the planet. That's what we do. And so whether the society calls that ESG or triple bottom line or do good and do well, whatever we call it today, that's exactly what we strive to do with my company. We take words like integrity, servant leadership, relationship focused very seriously. My business partner and I are both West Point graduates, and we and our colleagues, bled and died and defended words like duty, honor, country, because we believe wholeheartedly in those words and what they mean. In the same way that for our company, these are sort of our rallying cries. The strategies that we employ at our company are adaptive reuse, value add, and renewable energy, and perhaps I'll get into those in a little bit later on. So this is my business partner and I. I'm so grateful that he has joined me on this adventure. We've been together here for almost 3 years now. We both have come from the corporate world, myself as a healthcare executive, ending and culminating almost 20 years of healthcare as an operator as well as business development. Got into commercial real estate within the last 5 years or so, and both he and I, as I mentioned, are both graduates of West Point, served in the military as Army officers, have our MBAs. Married, I've been married a little bit longer than he has. I hit 22 years, if you can believe that. Yes, as young as I look, I've been married 22 years, and I've got 2 kiddos. One of whom actually just got accepted to the University of Texas, which is where he'll likely go. So hook 'em horns. That's where I got my MBA. Okay, all right. So let me start with this. Cash is trash, and let me explain a little bit of what that means and sort of the angle that I'm coming from. But let me first start by giving credit where credit is due. This is a term that I got from Grant Cardone, who I consider to be a mentor in some capacity, just really following a lot of his content and just admiring from afar all the things that he's been able to accomplish. I think I don't know whether he got it himself from Rich Dad, Poor Dad, but I do think Robert Kiyosaki may have said this in his book as well, just making the argument that I'm attempting to make today, which is it is far better to have cash flow as opposed to simply having cash. Of course, there are pros to having cash in the fact that, if you've got it, it's readily available and you can use it, as opposed to, if you had some other type of an asset or instrument or seashells or rocks or whatever used to be traded back in the day during the bartering system. It's readily available. It's readily acceptable as our form of currency in the US. I don't think there's a country anywhere that would deny receiving that, although they may prefer to have local currency. And then, of course, there's something to be said about having having a sense of comfort and security because you've got a certain amount. I don't think I'm the only one who will look at my personal bank account and have a sense of relief that, okay, we're okay. There's cash there. There's money there. And so if that is you, then I totally get that argument. Some cons I'll outline here. Obviously, cash is subject to inflation, right? And that's really because of the time value of money. We know that $1 today is worth more than $1 tomorrow from economics class in college, and perhaps in your own professional experience. And then, the other reality is that it's an asset However, it does not produce income until you put it into or deploy it into some form of income generating vehicle. Okay, and so it takes just looking at sort of the balance sheet structure with assets, liabilities, and owner's equity to realize that it is an asset. However, if you have more than the value of your cash in the form of liabilities, then technically you're netting out on your owner's equity. Or if you have more liabilities than you have cash, then obviously you're negative in terms of your equity. So that is why I am saying cash is trash, and why cash flow is king. Okay, so let me talk about cash flow here a little bit. So when we're talking about cash flow, we of course have to look at an income statement, and we know with an income statement, you have your top line revenue, and really any forms of revenue that may come in. If you're talking about, let's take the example of a multifamily unit or an apartment complex, you have your rental income, but then you may have additional income as well from parking fees, pet fees, and those types of things. So that constitutes your revenue section. And then you subtract from that your expenses, things like property taxes, insurance, utilities, those types of things. And when you do that, you come up with your net income, or your net operating income. Okay. After your net counter for that debt service, so that's your mortgage payments, then you have what's left over, which is your income statements, such as we're looking at right now. There are really three main levers that you can pull in order to increase the amount of cash flow, or to affect the amount of cash flow. The first is your revenue section. The second is the expenses section. And then the third is your debt service. With regards to revenue, you could always, the things that you can do within that you could increase the revenue would be to sell more. Either you're selling to more people, or you're selling more products, you're introducing maybe more service lines, but you're increasing your volume, right? The other aspect of revenue that you can increase it is by raising prices. So again, going back to our apartment analogy, you could raise rents, and therefore you would be increasing your total revenue. Obviously, depending on the amount of rent increase or price increase, if you're looking at a goods that's being sold in a store, for example, there's really an upper limit as to how much you can raise prices before buying decisions start to change, and customers end up going elsewhere. With regards to expenses, you can cut costs. Of course, within expenses, you have to distinguish between controllable and non-controllable costs, because non-controllable costs really are sort of fixed costs that you have to incur, at least on an annual basis. For example, property insurance. You've got to pay that, or risk not being covered, and that would violate then some debt covenants that you might have with whatever loan that may be in place for a property. You also have property taxes. If you don't pay your property taxes, then very likely the property may be foreclosed upon from a tax lien perspective. But there are certain costs that you can cut out, right? And just thinking about your own personal finances, for example, cutting out subscriptions to various different, streaming services might be one of those things. However, there are also limitations on cuts. We know that if you cut too many things, you can start to affect quality of the product or the service that you're delivering. And so even there, you have limitations on how much you can actually cut. And then finally, looking at debt, we always strive to get low interest rate fixed term debt. right? That's the ideal. Obviously, in the interest rate environment that we're in, getting low interest is not a thing right now. And so you have to be very careful. And then, typically when you're doing construction projects or, value add renovations and things like that, you can source variable rate loans, but not having a cap on that would be unwise. And so we always strive to try to have a cap on how much those rates can increase. All of that to say, these are the different factors that can affect your cash flow, and to the degree that you can increase revenue, reduce expenses, and minimize your debt service, how much your mortgage payment is, will determine how well that you can cash flow. And if you're cash flowing, then the argument then becomes, and I'll cover this here in a moment, that's an indicator of that property solvency that allows you to provide returns to investors, that really gives you some cushion to feel safe. Like some people feel safe when they're looking at actual cash in the bank. Okay. And then, one note I forgot to mention with regards to debt service is that even if you were to pay down the principal for any kind of loan, that doesn't necessarily mean that your ongoing debt service, your ongoing mortgage payments changes or it is reduced. So that's not really a thing where you reduce that unless you go through a loan modification with the lender, which is not something that they readily will agree to. Okay, so before we go into what does all of that mean and whether or not the argument is valid, let me just take a stab at putting on my economist hat. I'm not an economist, by the way, but it doesn't take much to look at what's going on in the economy and some of the standard indicators that are out there in order to be able to have some semblance of how you should go about considering what types of investments that you might pursue, or really just decision making around investments or your own personal and also your business fiscal policies and things. So with regards to GDP, while the government's target really is that 2% range, at the end of 2023, we ended at 3.3%, which is an indication that, consumers are still spending. That would be considered, sort of red hot still. And because our GDP is based on consumption, if we know that consumers are still spending, that GDP rate, that growth rate is still going to be higher than expected. In Q1 of this year, the initial outlook was that 0.8% would be what it would be. And then midway through in February, that was adjusted to 2.1. So while it's less than where 2023 ended up at, it's certainly significantly higher than where it was projected to be to start off this year. With regards to unemployment, here again, while the target is 4 to 6%, which is what the Fed is aiming for and doing so in a very diligent and what's the word I'm looking for? A very diligent and persistent manner. Our Q1 outlook had it pegged at 4% from the outset at the beginning of Q1, and was later adjusted to 3.8%, which all of that simply means that there's still a lot of people who have jobs. So unemployment rate is still considered all-time lows. And then, of course, inflation, when you look at starting in February 22, where it was almost 8%, in February of 23, it came down to 6.04, and February 24, so just 2 months ago, it was at 3.15. It's clearly heading in the right direction. That is the question that the Fed and Jerome Powell is wrestling with is that enough, and does that get us where we want to be? And again, while it is positive that inflation is down, when you balance that, or while he and the Fed is balancing that with GDP still being above the target and unemployment being off the mark, I don't know how much movement we're going to have in terms of interest rate reduction in the near term. That's just speculation on my part, but just sort of reading the tea leaves, that's what I'm coming up with. As it stands today, as of yesterday at 11:38 p.m., 4.412 is where we're at with U.S. 10-year treasuries. Okay, so all of that to say, these are some conclusions that I'm drawing that perhaps you may readily adopt or question, but it's up to you. One is that, cash is preferred if you in fact need it quickly. If you need access to do something or to pay something, you don't want to have to go and sort of liquidate an asset or sell something. It's nice to have that readily available. So I completely get that. The other thing too, and which is a reality, this is sort of not up for argument, is that cash loses value over time because of the time value of money, because of inflation, et cetera. It's just a matter of what that degradation looks like over the course of time. Which means that you should consider deploying it into assets that generate income and or that increase in value, because in and of its own, cash does not grow in value because of the things that we've been talking about. The next is we know that cash flow is affected by these three main levers, just really high level. These are the three main levers. So income or revenue, your expenses, and then of course any debt obligations, in this case, debt service is what we talked about. Now, cash flow production is a good indicator of financial health, like I mentioned earlier. If the property is cash flowing, if the business is cash flowing, that means it, at least from a cash management position, is able to take care of all the expenses it has to pay, as well as any amount of interest and or debt service that it's also obligated to pay, and still be able to produce that cash flow. At a minimum, you want to be at least cash flow positive by $1. and at best, or not at best, but ideally, you're able to generate the cash on cash returns that investors who may have invested in a deal are expecting, such that they can receive that. And again, that would be a good indicator of the health of that property, that project, of that business. The other thing that we have to consider is that it does in fact allow businesses, properties to weather any storm. So whether that's any economic downturn of any type, whether that's a change in consumer behavior, all of those things are baked into the property's financials. So if there's a change in how people rent, if for example, again, going back to the apartment example, should people start to buy homes more so than renting apartments, then that could impact the rental income for a property, but that would also be baked into that. So despite whatever impact that had, once you took away your expenses, once you paid your debt service, and yet it continued to cash flow, then again, that's a good indicator that property is remaining solvent and profitable despite whatever changes in some of the demographics or dynamics of the marketplace may entail. It certainly mitigates insolvency as long as you're able to produce cash, as long as you're able to take care of all of your expenses, take care of any amount of debt obligations like your debt service, and still be able to produce cash, then you can ride out any storm. You can continue to remain not just in business, but profitable. And then, as I mentioned earlier, similar to point A here, point 4A, having a property or business that is cash flowing sort of makes it indifferent to whatever market fluctuations may be occurring. And so helps to better safeguard the viability and the long-term sustainability of that business. So then ultimately, the argument here and sort of what I am purporting is we just need to get more cash flow. And the question then becomes, but how? And so I'd like to share some thoughts on that here. And so here are some available options that sort of come to mind readily for me. One is, if you're truly looking for some type of cash flow, personally or otherwise, you can consider fixed income bonds or CDs, certificates of deposit. Of course, the yield there that you would be getting is not something to write home about, in your mid 5%, which at this point, given where inflation has gone, you can at least say, okay, you know what, I'm outpacing inflation, or at least where it's at now. when inflation was at north of 5% or the mid fives, then you're still losing money by investing in these types of fixed income assets. From a timing perspective, as far as payments are concerned, they typically pay semi-annually or whatever the for a CD, whatever the time period is, whether 3 months, 6 months, 12 months, et cetera. You get that, you get the return of the face value as well as the interest that's paid upon in addition to that. But as far as bonds are concerned, if you sort of leave it in place, you're really only getting payments on a semi-annual basis typically. But then again, it is very liquid, right? Other than the CDs where that has sort of a time horizon, bonds typically have a good measure of liquidity. But yeah, for the most part, these are very liquid. Stocks, dividend paying stocks in specific. So I want to distinguish that. And these are really, when you think about one of the best investors in stocks who's ever lived, Warren Buffett, really his portfolio consists of dividend paying stocks. And so I'm not talking about investing in stocks simply for the appreciation component, but rather for that, but also the fact that if they're paying dividends, at least that's a form of income that could be then coming into you. These dividend paying stocks typically don't have a high rate of return. They typically have comparable yields to bonds. Payment timeframes can be annually, can be semi-annual. Most oftentimes, quarterly dividends are what are paid out. I'm not aware of, although there could be monthly dividends that are paid for some stocks. I've not come across them yet. These two are very liquid. You can sell these on the open market pretty regularly. The next one is commercial real estate, which is sort of the space that I play in. I think many investors who are customers and clients of Quest probably are investing in alternative assets like real estate. And so I do like commercial real estate because of the yield component. So because of the cash flow that is available and the income that it can produce for investors, the amount obviously varies and it can vary widely. It could be as high as, in the high double-digit ranges for certain properties, but it could also be at a point where the property isn't cash flowing until a level of incubation has occurred where the property is now online and producing and generating income. That's just one component of commercial real estate. However, the other ones I really like as well, which is what to me helps make real estate sort of a preferred alternative to the other ones that I outlined here. One is the capital appreciation or growth. Certainly better than bonds or CDs. Typically, you're just getting back your initial investment from that, and as well as the income that was generated as a result of that. Also superior, in my opinion, to the S&P historical average. So again, as compared to stocks, the standard IRR for most private placements is that 15% threshold. That's really what helps to ensure that you're on a compounding basis. Your money will double in a 5-year period. And so when you compare that 15% IRR to the historical average of the S&P between 7 to 8%, not including fees and everything else that typically would be charged, the net effect of that typically means that you're not getting a 7 to 8% average return over time, but rather less than that. And so I would argue that growth prospect for real estate is even superior to that of the S&P. Tax benefits, you're not going to get this with these other ones, although municipal bonds, for example, could provide a tax shield against the returns that you're getting or the yield that you're getting. However, by and large, real estate provides far superior tax benefits to bonds, CDs, and stocks. And that's largely driven by the depreciation that is available for real estate properties. The other, $1 can buy you $3 to $4 worth of real estate, whereas $1 in a fixed income bond or stock will buy you $1. And so this is one of the magic things about commercial real estate in terms of being able to utilize leverage there. And then finally, capital preservation. very similar, I would say, to fixed income bonds and CDs. The amount of money that you invest into this asset, one of the reasons that people are drawn to it is that you can park your money for an extended period of time and know that because of inflation and because of the growth that is likely to occur for real estate, which history has demonstrated that you're not going to lose that money that you invest into an asset, most likely. Unlike if you invest in a stock where it's completely at risk and that could be depleted by a significant amount or in its entirety. So let me pivot real quick now to tell you how we're going about this in light of the economic conditions that I described, in light of sort of this argument that cash flow is king as opposed to cash. We're investing in bridge loans for renewable energy developers. And so that for us allows us to produce, that allows us to invest in investments that have low bond-like risk, in large part because these investments are collateralized with long-term, what they call power purchase agreements. And these are agreements for companies like Meta and Google and Intel to buy power from a renewable energy source as opposed to their local utility, for example. And so the fact that they're collateralized by these very lucrative PPAs helps us to have a very secure and collateralized investment. And yet, despite the low risk, these investments that we make are generating equity-like returns in the double-digit range. And so, for example, I think it was mentioned that we run an investment fund, and in that we provide a 12% annual yield to our investors, and we pay that on a monthly basis. So not quarterly, not semi-annually, not annually, but rather on a monthly basis. And we've been doing that for nearly 36 months now. And so that is something that we do as far as how to produce high yield yet low risk investments. Okay. The other thing that we've started doing recently that I'm super excited about is something called triple net medical office buildings. And so for those who may not know, a triple net lease, and I should have put triple net lease for medical office buildings. For those who may not know, a triple net lease indicates that the structure of that lease has the tenant responsible for the three large ticket items for operating expenses, which are taxes, utilities, and insurance, but also may include common area maintenance. So imagine your doctor's office, right? If you go to your doctor's office, very likely that physician, if they're whether they're part of a group or they're an independent physician, very likely they don't own that building. They're simply leasing it from the owner. And by leasing it, they have a base rent that they're responsible for. But in addition to that base rent, they also are responsible for paying at least their prorated share, depending on the size of the building, how much they occupy of it, of the property taxes, the insurance, and the taxes, insurance, and utilities. Okay. And then again, as I mentioned, common area maintenance. There are some situations where there's something called an absolute triple net lease, which is where normally in a triple net lease situation, the owner of the building would continue to be responsible for improvements or repairs to the roof, the structure of the building, and the foundation. In the case of an absolute triple net lease, the tenant is also responsible for those things. So guess which structures that we like as building owners? You guessed it, absolute triple net leases. And those are the ones that we're aiming to pursue. Now, within this structure, you can also do something called a sale leaseback, which I love because it simply means that, again, using this example of your doctor's office, let's say they do currently own that building. Well, what we're doing is we're approaching them and saying, hey, you've been in this building for quite some time. If you would like to liquidate if you would like to monetize your real estate, let us buy it from you, and you can continue to operate in this space via a lease of that same exact space. Okay, there are two situations right now that we're pursuing exactly like this, where the seller is selling it to us and then they're leasing back that space. And so, and these are medical office buildings. So that's one type that you could pursue. The other thing that we're doing now, in fact, we launched a whole fund focused on adaptive reuse. In fact, the name of the fund is Redemption ARMOR Fund. ARMOR stands for Adaptive Reuse and Medical Office Realty. So that's it. Our investment thesis is embarrassingly simple, which is because of what's happening in the office space right now, we're buying office buildings for pennies on the dollar and then converting them to medical office buildings. And so I won't go into too deep of detail here because I want to leave time for Q&A, but this is our investment thesis for the first part of what I talked about, which is the renewable energy projects and how we're issuing short-term bridge loans to renewable energy developers. We explain why we're focused on solar because of the low operating cost and the cost in general that has come down significantly. On the bottom right, we provide an example of what a $100,000 investment would do. I just took this slide from our pitch deck for that. And then on the left-hand side, we really talk about the reasons why we like investing in that. The asymmetric return profile that I mentioned before, which is the bond level risk, but with equity level returns. The fact that we can take the same base of investment that gets repaid to us and then reinvested again. We're calling that bounceability. Consistent deal flow. There's so many projects right now that are pivoting to sort of a renewable energy component, and we're calling this the green wave. And then finally, the social impact component, as I mentioned to you, harkening back to the very first slide that I talked about with our company, doing good and doing well. Our investment thesis for the fund that I mentioned, and again, I'm saying for our fund, just to give you insight into what we're doing, this is certainly something that folks here listening can pursue themselves. I'm happy to share it just because I feel like the more of these types of projects can be done, the better place the world can be in terms of taking properties that would otherwise be vacant or underutilized and then repurposing them for the local community's benefit. And so what we do is we buy properties for 20 to 30 cents on the dollar. We add another 10 to 30 cents, if you will, for construction renovation. And so all in, we're still 50 to 60% of what it would cost to build that asset brand new today, which is significant. And I won't go into it now, but very advantageous for a lot of different reasons from a risk perspective. What we then do is convert these buildings to a medical office building, whether that's an ambulatory surgical center at the top right, clinics, dialysis, medical co-working. RTC is residential treatment centers. So that would be underprivileged at-risk youth and housing them. Dialysis, I worked it for 3 different dialysis companies for a total of almost 8 years myself. So I know that space well. And then one of our co-fund managers is a surgeon. So we know the surgery center space pretty well also. And then, of course, any property that you acquire involves a capitalization. And so we talked about earlier. And so there is a debt service that we would have to be accountable for. But let me make this point there. If the amount of debt is significantly lower than what it would be otherwise if we built this brand new, and yet the amount of revenue that we're generating is as if we built it brand new, and it's because of the leases and the income that it's producing. Once we take care of our expenses, relatively speaking, that amount of debt service is significantly less than what it would be otherwise if we had to finance the entire the entire replacement cost or the entire build cost for a project. So hopefully that's pretty apparent in what I'm trying to describe. All of that to say that this is one of the ways that we're able to then generate the cash flow that we're talking about, because revenue is high, debt service is low, and we've taken all of our expenses, therefore cash flow is higher. So hopefully that follows. And then so this is sort of just a kind of, as I'm landing the plane, why it is that we're pursuing traditional office to do this type of strategy. A lot of companies now are not leasing large amounts of space anymore. Gone are the days where companies are leasing 10, 20, 30,000 square feet of space. If they were to do that, they'd have a ghost town because most of their folks probably work from home already, or they've given them liberty to do that. It's actually working as both as a recruitment tool and a retention tool for a lot of employers to offer that to their employees. And so these office buildings, many of them, and we've got a pipeline full of these, are either vacant or underutilized, sitting there idle, which is causing us to be able to buy them at a very discounted price. And then again, as I mentioned, turning them into medical office buildings because they are recession resilient, because they're in service or essential essential in-person services. So until and unless my surgeon co-fund manager figures out how to do surgeries from afar, and perhaps there's a future scenario where that happens, there's still going to be a physical location where that patient needs to be, even though he's able to do that surgery, sometime in the future from behind his desk. The long-term triple net leases that I mentioned, oftentimes these leases are 10, 15, 20 years in length. And so we set it, we forget it. We don't have to worry about whether that income is coming in. It's just by the first of the month, you pay the rent, and that's how it goes, as well as the operating expenses that you're responsible for. And then, okay, let me end there and then pivot to questions. I will say this: if you're interested in learning more about medical office real estate investing, check out this QR code, scan that, and that will take you to a page that has a lot of information there, as well as 25 reasons why we invest in medical office real estate to generate cash flow. And so you're more than welcome to do that. And then if there are any questions at all, send us an email here. And if there are any questions about renewable energy stuff, the fund that we have there, whether it's the renewable energy fund that I made reference to, or whether it's the Armor fund that I talked about with office buildings, Ashton is our marketing investor relations manager. And so she does a wonderful job engaging with our investors. But check that out and engage with her if you like. Otherwise, let me turn it over for Q&A and talk about why it is that I think cash flow is king.
Absolutely. Thank you so much, Christian. Real quick before we do go into some Q&A, I'm just going to run through a couple of updates and some announcements we've got from our side of things as well. So very first thing, just to kind of tie this all back into Quest and self-directed IRAs. This is, investing with sponsors, right? Like Christian's company is something that we have a ton of people do. So if this is something of interest, maybe either utilizing a current IRA or setting up your own self-directed IRA to invest in Redeem or other companies or any kind of alternative assets, please let us know. You can contact either myself, somebody on the IRA specialist team to kind of do any of the above. Real estate, private entities, notes are all certainly viable options. You can scan this QR code if you do have some interest. Maybe you have questions, want to discuss cost, best fit, right? Happy to do any of those where we try to be as, transparent as possible. So let us know what we can help with. You can also call us or just schedule a meeting using that QR code there. A few events that we do have coming up. So obviously this is aside from the weekly webinars that we do. We host Tuesday and Saturday events every single week, 12 to 1 p.m. Central Time. But the Expo is the next event that we have coming up, the next large event, which is, hopefully one of the biggest alternative investment conferences of the year in America. We're hopefully projecting for over 1,000 attendees here. It's going to be June 7th through 29th in the Dallas-Fort Worth area, specifically in Irving. So it's, to my understanding, maybe 15 or 20 minutes north of Fort Worth, and very close to the Loveland Airport there. But you can check out the event page on our website. It shows not only our agenda, the different speakers, panels, keynotes, all the, some of the vendors and sponsors of the event. It's going to tell you a little bit about some of the past expos, what we're trying to do here, how exciting we're going to make it. It really is just a wonderful time, whether you're, a very experienced investor, maybe you're new to the self-directed space, whether you find yourself somewhere in the middle of that. This really does have everything for everyone, right? Regardless of investment interest or experience level. There's going to be all sorts of people there for networking, for answering your questions, for learning more education, for learning about different types of investments. So I highly encourage y'all to check this out. Before we go to the next one, Mac, I think now would be a good time if we can pull up that video.
Right here, right now.
So we are here because we want to meet as many investors as we possibly can. Quest does a great job at putting people here at the event. This event, I think, is great for first-time borrowers, first-time investors, and experienced investors. This event is great for finding funds that could fit their investment needs. I get a lot of business from the Quest event. I talk to people, I network with people, and it actually becomes business after the event.
Awesome. Okay, so that was our a video of the expo we did back in 2022. You could see some glimpses and sneak peeks of some of the things that went on there. The casino night, if you saw a few of those people playing craps. We have some kind of networking social party that we do. This year's theme will be kind of 4th of July themed, carnival themed. So we'll have games and drinks and food and hors d'oeuvres and things like that there. So I really, really encourage y'all to check this out. Like I said, it's I guess kind of the eclipse of the events that we put on. So our last one was back in 2022. We didn't have one in 23. I guess generally it kind of works out to about every other year. So take advantage while you can. We actually have a promotion running right now. Normally this is applying to, this does apply to all general admission tickets. Normally general admission tickets are $450. So for a limited time, we are, setting them at 50% off using Hop to It as the promotion code when you go to buy your tickets. This is by far, guys, I mean, the biggest promotion that we're going to have for the expo tickets. I really encourage y'all to take advantage of it before this promotion runs out. It's going to be offered on the first 150 tickets used with the Hop to It promo code. And I want to say we're somewhere around probably half of that now, if not more, if I'm not mistaken. And this has been going for a little over a week now or two. So take advantage while you can. It won't be there forever. And we hope to see you there at the expo with us. A couple other things as we're getting very, very close to tax time here. We do have a promotion running for completely free accounts. So if you're interested in doing something like this, maybe moving some money over, making some contributions, and you want to do so very quickly, until April, on or before April 15th, we are setting up self-directed IRAs completely for free. Typically, we charge $100 to establish an account here at Quest. So if that's something that you might be of interest, let us know. Happy to help you get those set up as soon as possible. That way you can take advantage of the promotion. And then let me see, I think this may be the last thing we have here. Yeah. So in terms of our next quarterly socials, these are events that we do once a quarter here in our offices, Houston, Austin, and Dallas. So if you're local to Texas, interested in coming out to one of these, check it out. The theme for this, for the events in May, is going to be veterans turned investors. And I know that Christian mentioned he's a West Point graduate, which fantastic. So we're partnering with the Wounded Warrior Project to kind of put this on. Basically, we're going to have veterans and investors coming out to speak about their journey, their experiences, and hopefully kind of give some advice in that way. And I think really you'd be surprised how many people in our industry, in real estate and private investments in particular, kind of have that background. Christian, being one. There are other people here at Quest. So if this is something that appeals to you, if you know people who are veterans and could learn and benefit from an event like this, please share it, right? We love to give education as much as we can, and being able to hopefully impact such an important community, I think is fantastic. We will have networking like usual, food, drinks like usual, and our education at the end. So please, y'all can register there using that QR code. Rebecca is also putting some links for all this information down in the chat where you can register for the expo, more information on the expo, and then registering for the social as well, and any other webinars that we have there on our events page. Okay. That's all I've got for Quest updates. Let me go ahead and bring Christian back up. And we do have a few questions, I believe. So first thing here, actually a few different questions from Jason. Said, this is pretty interesting. I'd like to know about the triple net leases for medical facilities. Where are these located?
Yeah, great question, Jason. So, triple net leases exist in every market, right? And they're not just for medical facilities. They could be for quick service restaurants or retail or office buildings where, there are some companies that may still lease a pretty large swath of space, although they're becoming more and more sort of a thing of the past. But all of those structures are typically designed as a triple net lease, or they can be. If I was the owner, they would be. We have a preference for medical facilities in part because, I made the transition from healthcare to wealth care, having spent almost 2 decades in healthcare and really understanding kind of the demographics in that space, meaning over 50% of our population is over the age of 65, right? Of that segment, that's where 75% of healthcare dollars go towards, okay? And so when you think about from a business standpoint, customer lifetime value, there's a need to have places of care and treatment, these types of establishments to provide treatment for patients and things of that nature. Just one last example, when I worked in dialysis, it was interesting in that, I would see patients my nursing staff would see patients 3 days a week because that's what it takes in order to filter your blood so that you can continue to live. And so I felt really good about that sort of that life-giving care. And yet at the same time, from a business perspective, those are patients, those are customers that are dependent on the product or the service that we're administering within that space. And so I really like the medical space for that reason, Jason.
A couple other questions here from Jason as well. Do you also do leverage buyouts or partials with these?
Yeah, so technically, every real estate acquisition you can consider it to be somewhat of a leveraged buyout because you're taking upwards to 65, 70, even 75% in the form of leverage as opposed to buying it with cash outright. I think the term leverage buyouts are typically reserved for the acquisition of companies and using entirely debt in order to do that. So from a real estate perspective, I would say that these are more sort of partial leverage, if you will. Again, seeing as to the fact that about 65 to 75% of the capital stack is in the form of debt.
And Christian, I know you said this is kind of a more recent strategy y'all pivoted to, but how long maybe do you plan to keep these triple net leases?
Yeah. So the interesting thing about I can go on for days talking about this stuff. I really love this, by the way. So the experience we have in multifamily has really helped shape our outlook in terms of what we're doing now. The benefit of multifamily is that you can change rates on an annual basis, and so as long as there is a high enough demand, you can know with some pretty good assumptions that your growth rate will continue to increase. There is sort of a flattening of rent growth currently for various different reasons. The thing I like about triple net leases is, as I mentioned, these could be for 5, 10, 20 years. And yes, you may not get a 10%, year over year rent increase like you would in multifamily. However, 3% per year over 20 years is a pretty significant at on a compounding basis is a pretty significant growth rate. So what you can do is at the end of a 5-year period, which is typically how long we plan to hold these, at year 6, you can look at what that rent growth looks like, and you can actually sell the property based on that valuation, because you're buying a future income stream. And if it's a credit-worthy tenant that has built-in rate escalators, annual rate escalators, and they're covering the by and large all of the operating expenses, that's a really winning solution. And that's part of the reason we get excited talking about those triple net leases.
Yeah, fantastic. Jason's question is just in reference to the contact information. I'm going to throw that back up here on the screen. But Christian, I guess this is probably the best way for potential investors, people interested in more information, to reach out to y'all.
That's exactly right. Either going to our website or just contacting Ashton here at her contact information, and she'll help sort of triage based on different levels of interest and things like that. But yeah, that's the best way to get a hold of us.
Okay, wonderful. Let's see. I think that's actually all the questions that have come through, and it's kind of actually going to bring us to the top of the hour anyway. So we'll close out with that. Christian, again, thank you so much for taking some time out of your I'm sure busy schedule to speak to our platform a little bit and kind of give us some education on what it is that y'all do. Thank you, and hope everybody enjoys the rest of their Tuesday and the rest of their week.
Thank you. Thanks for having me. I appreciate it.
Absolutely. Everyone take care.